Is this volatility? How should you place your bets? Let's understand more on this. And for this, we are being joined by Chirag Mehta, who is the Chief Investment Officer at Quantum AMC. Hi, Chirag. Good to be speaking with you. First up, help us with your take on the markets right now. What we are seeing of late is that India is witnessing a bit of a recovery, but it's the global peers that are under pressure. Do you believe that the majority of the selling for Indian markets has already happened and maybe it's time to look out for some of the opportunities in this market, or do you believe that there could be some more pain in store?
Yes, so India was doing well in terms of economic growth over the last 2 years on a relative basis, and also market was reflecting that. But I think markets got carried away in terms of valuations that they were prevailing in across the segment, and more so in the mid and small cap segment, given the flows to that segment were very high. So overall, I think the correction was needed, was warranted, and we have seen that correction. And the reason for that correction, it was a slight slowdown that we started seeing in Indian economy per se, with nominal growth peg much lower than what was seen over the last couple of years. So that has given a reason for markets to correct that overvaluation that was prevailing. From here on, large caps have come closer, very close to the long-term averages that have been there. Of course, long-term averages per se have moved higher, but it is currently very close to the long-term averages. Small cap, mid caps are still a bit expensive, and there could be some more current downsides because of the high valuations that prevail in those segments. From a large cap perspective, I think there could be some pockets where opportunity is starting to emerge. But on a broader basis, probably as it's a pendulum that swings on both sides. There could be some more downside from here on, and would give a good opportunity for us to deploy further into the markets.
Where are you planning to deploy, Chirag, given the volatility that could be in store? And how much more correction, first of all, help us understand how much more correction could be in store, as well as at what given point you will start deploying and in which segments?
So generally, we are bottom-up investors, and we look at opportunities as they come, be it from a growth and valuation perspective in totality. But if you were to look at markets, we are seeing signs of things coming closer to levels that we would be comfortable buying. So maybe another, if there is correction of another 10% or so, would give us an opportunity to deploy some of our cash in the large cap segments. Small cap, mid cap, again, it's a bottom-up story, and we are seeing some signs of opportunities coming our way from a valuation standpoint, some very close to where we would like to. From a sectoral perspective, we are bullish on, or we are comfortable with the BFSI space, and across the BFSI space into the private banks, insurance companies, look pretty good from a valuation standpoint, and the growth that may come over next couple of years. We are comfortable in that segment. We are fine with the IT because there is some pessimism given what is happening in the global world, with the Nasdaq declining significantly over the last few days. There is some pessimism in terms of what happens to the IT, but I think Indian IT companies are a different ball game altogether. And I think we are comfortable with the Indian IT companies. If there is some pickup in discretionary spend overall as things stabilize in the global world, I think Indian IT companies, given the base has been lower over the last 2-3 years, could see some earnings momentum their way. So I think from a sectoral perspective, we are comfortable with BFSI, we are comfortable with IT as a sector, and we are comfortable with consumer discretionary to an extent, and more so in the auto names. And that is how we have positioned our funds across the spectrum.
But Chirag, the other thing I wanted to understand from you, that since you touched upon the fact that private banking space is looking attractive to you right now, and given today when we see one of the private lenders that is one of the top draggers in Nifty 50. Give us some sense that as a fund manager, how do you navigate such sort of a situation, since you might also have exposure, or people who must be having exposure. So as a fund manager, what should investors do, or how should investors get learning from you in this?
So overall, in the banking space across, you have to see in terms of how they have, what are the lending practices, what are the practices in terms of accounting that these banks follow. Or there are of course tightened regulations by the RBI in terms of how they have to recognize bad assets, etc. So you have to look at even post that in terms of the practices that these banks tend to have, and how are they growing? Are they very aggressive when it comes to their growth prospects, in terms of are they kind of taking more risk than they should be taking from a lending perspective, and what are the underwriting practices that they have, and you can over period of time, you can over the long term, you can very well see in terms of the differentiation that lies into the lending practices amongst banks overall. So accordingly, in terms of where the lending practices and the underwriting practices are good, we tend to give them a higher multiple and a higher weight. We would be comfortable with those kind of banks. Whereas banks where we have seen that asset quality usually has been a issue. There could be shocks that could come our way. We would even if it looks very very attractive, we would never lend a higher weight to those kind of stocks, and we would limit our weights to such kind of stocks. Again, this sector is very well regulated by RBI, and therefore, there are certain safeguards built in the regulation that would protect us. But over a period of time, what differentiates from the good ones versus the bad ones is the underwriting practices and the way they look at growth opportunities, and that is where the problem lies with many of these banks when it comes to their lending practices. So larger banks who have demonstrated that they can underwrite well in terms of the risk that they take while lending are the banks that we would be comfortable with, and they have strong disclosures, strong transparency. There would be enough checks and balances and risk management practices that they pursue, and that makes us more comfortable having a higher weight when it comes to these banks.
Right. Hi, Chirag. Good afternoon. This is Shailu also joining in the conversation. I would like to play a devil's advocate here. You did mention the fact that you like IT services, you're overweight on that one. Right now, we're seeing a lot of murmurs, a lot of jitters around the globe, especially with the global brokerages saying that they have gone ahead and downgraded the US equities. They are actually not too confident about the way how the economy will shape up going ahead. And the fact that the US economy doesn't do well, does not bode well for Indian IT companies, at least, given the fact that we are exporters of the services. So what's your take on that? Do you think you should shrug off those fears and still bet on the IT sector, or should you take a cautious approach and look at that space?
So this is not the first time that we have witnessed these kind of fears in the market, right? Be it right from the dot-com bust to the cloud that came into way, and now the AI. We have seen that Indian IT companies have transformed their way out. And with the fears of tariffs, etc., firstly, we have not heard any tariff-related talks on services per se. Second is, even if they were like they're talking about Make in America, the unemployment rate in the IT services space in the US, it's amongst the lowest, and hence there is not enough talent. If you were to replace and get those jobs back, there is not enough talent in place in terms of being able to do it in America and service from an IT perspective. So I think we have seen those fears before, and Indian IT companies have navigated each time well when it comes to this. And it's talking about the long-term thesis of the sector. It's about the arbitrage really between a US-led employment versus an India-led service, which comes at 1/3 of the cost of what you get in the US. And hence, it makes all the more, that thesis is still very, very intact in terms of playing it way through. So we don't think that there are large fears. Of course, the growth has been slower because discretionary spend was not there. And anytime there is a crisis, there is a need to cut cost and look at cost efficiency. And at that time, IT has usually had an upper hand in terms of aiding that cost efficiency. So we think that on a holistic basis, there could be near-term jitters, but I think from a medium to long-term perspective, we are still comfortable with what Indian IT services can deliver.
All right, Chirag, with this, we'll let you go on that. Really appreciate you taking the time out and speaking with us.
If you like this video, then like, share and subscribe to ET Now.